Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Bloomberg reports Meta's considering budget cuts of 30% for its Metaverse group next year. The very group Mark Zuckerberg once framed as the future of the company. Shares jump.
Plus, Nvidia CEO Jensen Huang is not sure China would accept more powerful AI chips, even if the US relaxes restrictions on the sales. We discuss.
And we break down the latest tech earnings results from Snowflake and Salesforce, and we'll be joined by the UiPath CEO too.
But first, let's check in on these markets that are struggling to find direction today, Ed. We've been higher. We're now pushing back lower on the Nasdaq 100, off by 0.3%. Real catalysts, we're still waiting really for next week and the Federal Reserve decision. We still get that myriad of jobs data that we try to digest. We're looking, though, at Bitcoin just coming off by 0.8%. At one point, it broke into positive territory for the year again, but we're now back to 92,973. But what are you looking at on the individual stocks?
Yeah, one single name where the stock does have the direction. It's our top story. Meta shares off their session high, but up 4%. Bloomberg reporting that executives are considering cutting up to 30% of the budget for its Metaverse initiative, along with wider cuts. Let's talk more about what Meta's plans mean for the company with Bloomberg's Kurt Wagner, who broke the story and joins us with the reporting. Sounds like in the last few weeks, last month, Zuckerberg assembled leadership. They looked at the budget for next year, and Metaverse is where they want to focus their cuts. Bring us your reporting.
Yes, so this is an annual thing, right? Looking ahead to 2026 budgets. In this case, Mark Zuckerberg has a nice home in Hawaii where they have a series of meetings. Executives come in the month of November. And to your point, they talk about this year 10% cuts sort of across the board, looking at all the different teams, but that the Metaverse has been asked to cut much more deeply than that. As much as 30% is currently being discussed. I should point out it hasn't been decided yet, but a cut of 30% would certainly also come with layoffs. So to your point, this is an effort that Mark Zuckerberg has touted as being the future of the company for years. Mm-hmm. So it's a pretty meaningful change there.
Let's go back to when he thought it was the future of the company. Just take a listen to Mark Zuckerberg back in 2021.
If we all work at it, then within the next decade, the Metaverse will reach 1 billion people, host hundreds of billions of dollars of digital commerce, and support jobs for millions of creators and developers.
Boy, a lot has changed since then. And that was a long time ago, Kurt. But we still will get, the idea that we'll have augmented reality. We're still focusing in on the glasses. It's just not the actual virtual worlds and working out.
That's right. And the virtual worlds aren't going away, to be clear. It's still going to be something that they invest in, just not quite as aggressively as they had. And what was explained to me by sources this week is that part of that is that the market has not really materialized. You know, I think they originally spent a lot of money building out this Metaverse group, thinking that they would have competition from others in the industry rushing towards a Metaverse-like product as well. That has not happened. And so it's not necessarily that Mark Zuckerberg no longer believes in this. I'm told that he still does. But clearly they have overspent to try to build this thing. And I think the ultimate goal is to get to these, AI-inspired glasses and AR glasses. And maybe the Metaverse was a stepping stone to that all the way.
So actually it signals a commitment to AI hardware, distinct from Metaverse hardware. I thought it was really interesting that shares of Essilor-Luxottica, who they partner with to make the Ray-Ban Metas, kind of rose a little bit after the story. And all of the analyst notes, and there are many actually reacting to our reporting, say this is probably bullish for AI spending. At the same time, Bloomberg reporting that Apple's most senior design executive going to Meta.
Right. They are not giving up on hardware, right? The VR virtual reality group is expected to be hit by these Metaverse cuts, right? That is the immersive Metaverse product. But they are still investing in AI glasses, the Ray-Bans that you mentioned, Ed. They are still obviously bringing in big talent and poaching people to design these things. This is what Mark Zuckerberg talks about on earnings calls, AI. He talks about the glasses. Those things are not going away. It is the specific kind of immersive virtual stuff that it looks like they're taking a second look at.
A reallocation of resources. Kurt Wagner, a huge market-moving story. Thank you for joining us on it. Let's talk more about the market moves. Nancy Curtin's with us. She's Global Chief Investment Officer at LT Tiedemann Global. Nancy, you've actually been writing really saying that we are currently in an innovation-driven bull market. But what does this move from Meta and sort of the moving around of capital expenditure tell you about where we are in the cycle?
I mean, I think the thing is about innovation-driven bull markets, and we've had, pretty much 3 of them before this one, which is they tend to be characterized by a couple of different risks. CapEx expenditure is quite large. Companies need to tap the debt markets, and there's shifting perceptions of the winners and losers. So, these bull markets last longer. They go beyond people expect. They tend to come with productivity improvements, but you do get some shifting perceptions and shifting priorities. So let's just bring that back to Meta. They've got a lot of money that they want to spend on Gen AI. The market hasn't liked the fact they've tapped into the debt market to do that. They've got less, in a way, cash flow than some of the other companies making similar levels of CapEx spend. So I think this is a good and, sane reallocation of resources
Nancy,
towards AI, which is the prize.
Nancy, I want to go to something you just said. I think it's critically important. Cash flow. If you look at the reaction to this Bloomberg report on Meta, many would note that Meta was headed for negative free cash flow next year.
That's right.
This year, the story was about Oracle hitting negative free cash flow for the first time since 1992. Is that a worrying set of data that you're seeing on your desk?
Yeah, because I think the market's being more discerning now. It's recognizing that some companies have cash flow that can support this, and some companies really need debt. And Oracle is a good poster child for not only being late to cloud, spending quite a lot of money, being very tied into the open AI in terms of contracts and the risks associated with that, but also using debt. And I think their debt to EBITDA is like 4 times. So it's in a completely different category. It's kind of in the CoreWeave department in terms of indebtedness. And investors, quite rightfully, are becoming more discerning about the risk associated with, financial leverage.
And then there's the risk in the private markets. How are you seeing OpenAI playing as a virtuous or a vicious circle right now? Is it a single point of failure, or is it the one that you need to be allocated to?
It's a little of both, let's face it. OpenAI declared code red yesterday, the day before yesterday. Look, it's facing competition. It recognizes that Gemini is really, and if you've used the Gemini 3, it's pretty impressive. It's not as friendly as ChatGPT, that's a personal relationship thing going on, but it really is quite interesting in terms of Nano Banana, the image editor, as well as, I would say, complex reasoning is really quite good in Gemini 3. So OpenAI is facing competition. They got to focus. They've been spread across a lot of different dimensions. I think they're refocusing now on personalization, reliability, speed, and continuing to build out that OpenAI large language model to maintain their lead, right?
Nancy, we came into this morning when we met as a team thinking probably we focus on Salesforce and Snowflake earnings. And then we got the Meta report, right? Your thesis is that you have innovation cycles driven by heavy CapEx, monetization follows. Actually, if you take the different part of the stack with Salesforce and Snowflake, tepid outlook in terms of profits and top line growth from all the AI investment. Is that a fair point I've just made?
Yeah, because I think that the problem is in innovation bull markets is CapEx starts and you've got to build out the CapEx and the revenue follows, sometimes years later, sometimes within a couple of years. And so investors have to extrapolate, is the investment really going to deliver the revenue and profits and the rate of return? And not everyone's going to get there. And that's the risk of innovation-driven bull markets. There are some winners, there are some losers along the way. But, I think the key is you've got to really focus on who is delivering the revenue today, or at least the visibility of that, and who has the wherewithal. And just an example, Alphabet's got, 150 billion of operating income. OpenAI is losing $9 billion a year. So, the wherewithal, the financial might, probably, I think investors are thinking may sit with Alphabet at the moment.
We're going to go very deep later in the program on the earnings from Salesforce and from Snowflake, but there was a very interesting across-the-board look. Nancy Curtin, Global Chief Investment Officer at LT Tiedemann Global, thank you very much. Now, coming up, Nvidia's Jensen Huang looks to win over Washington on chip export rules, but Could it be too late for the AI chipmaker in China? We've got more on that next. This is Bloomberg Tech.
Going toe-to-toe against anyone, the American technology industry has nothing to fear. We are mighty, we're fast, we're inventive, we'll take anybody on. In the case of China, we shouldn't concede the entire market to them. They're formidable, but conceding that entire market, we ought to go compete for it.
Nvidia CEO Jensen Huang there speaking on American AI leadership at the CSIS conference in Washington yesterday. Huang also met with President Trump to discuss export controls on his chips, noting some uncertainty over whether China would even accept the processors if restrictions were indeed eased. Here with the latest is Bloomberg senior tech editor Mike Shepard. And Mike, we're talking about H200s in particular here, and it feels as though maybe Jensen thinks the ship has already sailed. They're limited and wanting to focus on domestic, really.
Yeah, it's unclear exactly where things stand internally inside the administration on the H200 and whether Donald Trump will give the ultimate green light for those chips to be sold to China. You'll remember just a few weeks ago before the holiday, we broke the news that administration officials have been deliberating this idea of allowing the H200 to be sold to China, to be exported to China. And this would be a significant relaxation of the export controls that have been in place on AI chips since 2022 and have really hampered Nvidia's ability to sell into China, which is the world's second largest AI and chip market right now. And it's something that he has made a priority, even though Nvidia is not putting the China market on its forecasts or anything else. Yet he's identified it as a $50 billion opportunity for the company.
The baseline assumption is zero China revenue, right? But Jensen Huang's keeping himself in proximity not just to the administration, but to Congress as well. Whether China wants those chips, we'll talk about that with Peter Elstrom in just a minute. The GAIN AI Act is also a part of this lobbying effort, and it's an area where maybe Nvidia is nearer to a win. Could you just explain the basics of legislation or a piece of it that was omitted in Nvidia's favor?
Oh, of course, Ed. And this was actually a big portion of his visit to Washington. It was another whirlwind day in the nation's capital for Jensen, who has become a regular here in Washington, both on Capitol Hill, but even more so at the White House, where he has forged that close bond with President Donald Trump. What Nvidia has been trying to do is fend off this GAIN AI Act, which would prevent or make it at least very hard for Nvidia to sell to China and other U.S. adversary nations without explicit permission from the U.S. government. The company has argued that, look, we don't need these restrictions in place. The Commerce Department already has the authority to do so, and there is no competition between customers in China and the customers here in the U.S. The bill also would have required the company to give first dibs to American buyers. It looks like lawmakers are going to exclude this provision from must-pass defense legislation that has to be done before the end of the year. However, we can't consider it completely dead. Our sense is that Congress may try again. There is bipartisan support for this idea, and we do get a sense that some lawmakers still have concerns about allowing China to have access to some of those advanced AI chips from Nvidia.
Bloomberg's Mike Shepard in Washington, D.C. Thank you. At the same time, China's ramping up support for domestic chip production to occupy a vacuum that's been left by Nvidia's forced exit. According to sources, Beijing-based Cambricon is set to triple production of AI chips in 2026, with plans to deliver 500,000 AI accelerators, the vast majority of which are advanced. Bloomberg's technology executive editor Peter Elstrom joins us. Cambricon is another example of a domestic player with an AI accelerator product. It is reliant on SMIC, China's domestic version of TSMC. And this is an interesting piece of reporting. Bring us the details, but also, technologically speaking, the differences of where Cambricon and SMIC are versus Nvidia, because the scale is completely different.
Yeah, this is exactly what Jensen Huang is talking about. This is exactly what he's concerned about within China, that after the Biden administration first decided to cut off shipments of Nvidia chips into that country, the government and the companies there saw the market opportunity, they saw their own vulnerabilities, and they decided to invest very, very aggressively in their own production technologies for chips and also AI design. So Huawei is really the primary competitor that we have been talking about. They have quite a bit of momentum in building these AI chips. They've been used in a number of different places there. Cambricon is really the second player. It's sort of like the AMD for that market. They're quite small at this point. They don't have the kind of heft that Huawei does in particular, but they are making a lot of progress. So what our sources have told us is that their plans are to triple their production of AI chips into next year. There'll be a pretty significant second to Huawei in supplying those chips. So to the broader question about what U.S. export controls do to this market, as Jensen Huang is talking about, it certainly has opened it up for domestic production. Chinese companies are being told by Beijing that they should buy domestic chips whenever possible. They've also turned down this idea that they're going to buy Nvidia's H20 chips. They don't think that those are good enough for the market. So as Mike Shepard was talking about earlier, there may be a discussion about H200s, but there's no putting this genie back in the bottle. China has decided they are going to make their own chips domestically, and they're making a lot of progress.
They're making a lot of progress in designing them, but then they've got to get them spat out by SMIC, and it feels as though ultimately the production, what you're really garnering, isn't very many.
Yeah, that's a very good point. They are way, way behind the global standards. There is some desperation here that if you have to produce at lower standards, you will. But if you look at some of the details, it's very, very interesting. So SMIC is still producing these chips at 7 nanometer, so well behind the 3 nanometer that we see from TSMC at this point. Also, the yields, we got some insights into the yields. Only about 20% of the chips that they're making right now are actually usable. So that's only 1 out of 5 chips that they produce they're actually able to use. You compare that with the TSMC, which is up at 80 or 90% yields. Their economics are just totally different. But it's a sign of how badly Beijing wants to be able to catch up in this market, that they're just going to eat those costs. They're going to eat 4 times the cost of what it would cost some other globally competitive manufacturers to make these chips, because they feel like from a strategic standpoint, they need to make this progress.
Peter Elstrom, brilliant reporting. Thank you very much indeed. Shares of UiPath having their best day in 2 years after the automation software provider reported earnings that showed accelerating growth in the third quarter. I'm pleased to say founder, CEO Daniel Dines joins us for more. You're like the OG. You've been doing this for 2 decades, automating processes. You're thinking about repetitive administration and the tasks you can take away from a human. How are you building in AI agents into that?
AI agents are very complementary to our automation engine. We specialize over the year in bringing rule-based automations, and AI agents is bringing something that is much more closer to human intelligence. We've believed that the key aspect of bringing reliable AI to enterprises is to have a solid foundation of automation, and then AI comes on the top of it. And we connect, basically using our orchestration technology, we connect AI agents with robots and humans.
Daniel, I've been digging into RPA and trying to think about like what is new about RPA in an AI world. I think that was kind of the root of Caroline's question. One of the ideas is that there's a potential addressable market for you where desks with less technical staff can use your software because it's better at reasoning across documentation and those kinds of workloads. Just explain how you kind of grow the business beyond your traditional customer base.
Well, first of all, within our traditional customer base, there is a lot of room for expansion. And we are seeing tremendous opportunities in healthcare and financial services. So we really are expanding the reach of our RPA technology with this new agentic proposition. Even for the traditional RPA itself, we are bringing the power of GenAI to make the development faster and in some instances even more reliable. When, for instance, the applications changes a lot, we are combining now computer use type of technology with traditional RPA. So this combination of agentic, RPA, API, and orchestration is really what is the crux of our platform, and it resonates quite well with our customers.
Let's talk about that resonating, Daniel, because we're hearing more and more that really the barriers are at the moment adoption or a willingness to pay. How are you seeing clients deal with that?
Because many clients were initially investing mostly in like chatbots, and they don't get really the high, the outcomes. They don't have an impact on the bottom line eventually. What we are bringing on the table is the capability of delivering autonomous agentic automation. And this is even from RPA. We specialize in bringing this autonomous agents. And now we show to our customers that they can get significant benefits, and that can go directly into the bottom line.
Daniel, our colleagues at Bloomberg Intelligence, that's our in-house analysts, are a little bit cautious on your subscription revenues. If you look at where the street thought they'd be, basically in line, slightly beat, and they're worried about the sustainability of subscriptions. Are they right or are they wrong?
Well, I think they are totally wrong, guys. I have yet to see one piece of AI that was capable of replacing one of our robots. I think this is the most misunderstanding piece of technology when you feel that AI can replace RPA. RPA, it's a great last mile technology. It's rule-based driven, it's fast, it's reliable, it's precise. It works very well across the regulated industries, in healthcare, and AI is just a complement to it. I would say that agentic right now, actually, it helps improving our subscription business.
Daniel Dines, CEO of UiPath, with the earnings breakdown. Welcome back to Bloomberg Tech. Our top story is Bloomberg's Kurt Wagner reporting that Meta is considering cutting budgets for its Metaverse initiative by up to 30% next year as part of its budget planning cycle. That's all according to our sources. The stock reacting positively to the report, up 4% at the moment, on track for its biggest jump since July. Nothing's being decided yet. There will be an element of layoffs, according to our reporting, part of a kind of broader look at the company and refocusing from Metaverse to AI. But really interesting move in the stock, Karen.
Yeah, stock reaction. Now let's get you an analyst reaction, because Bloomberg Intelligence has been out there writing that these Meta cost cuts, Ed, along with potential use of Google's TPUs, could actually improve the company's free cash flow by at least $10 to $12 billion. Person helping pen that is Bloomberg Intelligence tech analyst Mandeep Singh. And Mandeep, we've been worrying about free cash flow of Meta, the AI capex spend. Is this helping offset that concern a bit?
Yeah, and look, based on consensus right now, we are talking about at least a 50% increase in capex for Meta next year. And no one, I think, would mind that, given everyone sees there will be lift in revenue from AI down the line in the near term. And I think they needed some offset because the stock was very expensive on a free cash flow basis. So this is a nice offset, and I think the TPU news was also quite productive in that direction, simply because they will be spending close to $50 billion on accelerator chips next year, if $110 billion is their capex number. So some portion allocated to TPUs, which cost maybe 25-30% cheaper, I think bring down that free cash, help offset that free cash flow, which is going to be negative next year.
Mandeep, a part of why the stock is pushing higher, I guess, is just the commitment to AI, right? The Metaverse and Meta's AI ambitions have overlap, but they are distinct in many ways. My question is there a Bloomberg Intelligence house view on what the story is with Meta, Metaverse or AI, or a hybrid of the both?
I like to think of, Metaverse ambitions as a moonshot for Meta. And look at, Google's moonshot, for example. It's like self-driving Waymo. That is a lot real than in terms of driving, tangible revenue, top line growth compared to what Meta has accomplished with that aggregate, $70+ billion in spend over the last 3-4 years. And to me, it's still a moonshot. And that's where, paring back and allocating that capital towards probably a more productive use case in AI where they will see some top line lift is the right thing to do. And I think the era of efficiency that Meta had a few years back may be a repeat, I think, in 2026.
It's interesting, though, because they've been spending a lot on talent, and they've just recommitted to talent when it comes to hardware and design, and they're really poaching a key executive, Alan Dye, over at Apple. Is that what you want to see, more leaning in maybe to the virtual reality offerings that we've seen that have been amplified by AI, the Ray-Ban glasses, for example?
I mean, I would say at this point, virtual reality would be de-emphasized over the glasses, the Ray-Ban glasses, as you said. And clearly, if they want to distill their model into a smaller version, that would run most likely on the augmented reality glasses. And that is a much better form factor than the virtual reality, where they have been subsidizing the hardware costs, but it really hasn't seen the kind of adoption that they could see with the Ray-Ban glasses, for example.
I'm smiling, Kara and Mandeep, because the stock being driven by Metaverse, you just said year of efficiency coming back in 2026. It's happening all over again. Mandeep Singh from Bloomberg Intelligence, thank you very much for the research. Let's turn to Snowflake and look at shares of the company, one of the big underperformers, big decliners. The company issued operating margin forecasts that fell short of analyst estimates, raising concerns about the profitability of new AI-based tools. Joining us now is Derek Wood, TD Cowen Managing Director, Senior Analyst covering the stock. Bring us your call on the stock and how you've reacted to this earnings print. I'm trying to understand how real the anxiety is. It's a big move in the stock and Snowflake finding its bottom line in this AI world.
Yeah, the stock had a big run into the quarter. I think expectations were running high. We were a little cautious, thinking that the upside on the top line would be a little softer than last quarter. We saw that. We saw a pullback. I think this is a great opportunity to get back in. In terms of the margin outlook, yes, Q4 was below, but the full year was intact, was in line. We don't typically see the company raise full-year margins intra-year, and so this was not a surprise. And the feedback was that they remained committed to driving margin expansion. They didn't give guidance for next year, but we absolutely expect margins to continue to grow next year. So I don't think the Q4 guide should be of concern, and remain constructive on the top line. The Q4 guide on revenue was above, and fundamentals remain. We're still bullish on it.
To your point, we're showing the year-to-date gain on the name, which is above 50% at this point, and that is important context. Look, I've just returned from AWS reInvent in Las Vegas, where Snowflake comes up, as does Salesforce, right? In the context of two companies that will benefit from a move into an era of agentic AI, but if you look again at the stock, the market doesn't seem to believe that Snowflake's a beneficiary of that, at least right now in the near term.
Again, near term, their expectations were a little too high, but year-to-date performance is great. They gave disclosures of hitting $100 million in ARR from AI products this quarter. That was one quarter ahead of targets. And they did just release Snowflake Intelligence, which is their new agentic AI capability that came out 1 month ago. We think that's going to unlock a whole new product cycle and really accelerate the adoption on AI. And, of course, Salesforce has their own agenda with Agentforce. And we think they both have great swim lanes to go after.
It's interesting. Let's compare and contrast the context of both of these stocks, because as you've rightly pointed out, we've seen Snowflake up and to the right this year. Not so for Salesforce, which has lost about a third of its market value so far this year. I'm currently seeing it off now about a quarter, 26%. Did it come in with a lack of optimism and therefore manage to steer that maybe it'll get back to double-digit revenue growth next year?
Yeah, I mean, the compare and contrast between these two, the apps group in software has been under a lot of pressure. And it's because they're seat-based revenue models. People are concerned about employee headcount. People are concerned about disruption from AI natives. Whereas on the flip side, Snowflake is a consumption-based pricing model. They're in the data infrastructure. And so there has been this big divergence between infrastructure software and app software, and Salesforce has fallen in that apps bucket. But it was encouraging to see the numbers were, they were in line and the guide was in line, but there were encouraging metrics around Agentforce and AI that show some good signs of acceleration. There were 3,500 net new paid Agentforce customers signed in Q3. That was up from 2,000 in Q2 and 1,000 in Q1. So we are seeing good acceleration on that front. And the percentage of customers that are coming back and refueling the tank to buy more credits and burn, as they're burning more consumption, that also went up. So both of these metrics going in the right direction is highly encouraging on, starting to see some inflection in Agentforce.
I mean, Derek, just broadly, are we getting any signs that software's lunch isn't being eaten by the large language model providers, that they can withstand this?
There's still a lot to prove, no doubt about that. And investor sentiment is super skeptical right now. We've always thought that 2026 will be the year of inflection in the software space around AI. It takes a lot longer to go through sales cycles, new product development, than some of the consumer stuff that we see taking off so quickly. And so we're hoping that 2026 is going to be the year where a lot of these new products kick into new gear. People get through proof of concept, move into production, start getting more comfortable with new pricing models. And we're hoping that is going to turn the corner on the sentiment for investors in the application software bucket.
Derek Wood of TD Cowen, great to get your analysis today. Thank you. Coming up, Anthropic CEO Dario Amodei. He's suggesting some AI companies taking too much risk by committing to spend hundreds of billions of dollars to develop and support AI systems. Remember, he's just committed to spending quite a lot to himself. We'll discuss that next. This is Bloomberg Tech. The CEO of AI startup Anthropic says some companies in his industry are making a risky move by committing so much money to building out the AI ecosystem. Dario Amodei, he's making these comments in an interview at the New York Times Dealbook Summit yesterday. Bloomberg's AI editor Seth Figman is here to break down why $50 billion that they've just said they're going to be spending on data centers and ecosystem is not a YOLO, whereas maybe some others in the space are.
A really modest amount here. I mean, look, it is an order of magnitude different than the $1.4 trillion that OpenAI is committing. And while Dario did not say OpenAI by name, it was hard not to feel that was the target of his criticism. I think the point that he was trying to make at a higher level was every AI company right now is taking on a certain amount of risk and embracing a certain amount of uncertainty. They're trying to anticipate what their data center and infrastructure needs might be 2, 3, 4 years down the road based on what they're seeing today, because it takes a long time to build this stuff. Dario is claiming we are making a measured, though still costly bet at $50, $60 billion. Other firms are just going off the rails and spending $1 trillion or more, committing to do so. There's a real problem there.
There's also a sort of methodology difference, which, Seth, we've reported on, right? The idea that Anthropic's probably less focused on building its own infrastructure, leasing capacity, doing deals with partners, stuff like that. Did he explain that kind of technological point of difference or business plan point of difference?
I think his emphasis was a bit more on they are not necessarily trying to be the mass market consumer-focused company in the way that OpenAI is, which also relates to OpenAI's current anxiety about Google's ascendance. Those are two firms that are equally vying to have 1 billion or more users for their AI products. What Anthropic is obviously doing is going after the enterprise market, getting customers who are willing to spend potentially big dollars to deploy this internally, and they see that as a higher profit margin business and one that may not require the extent of build-out that we've seen other firms do.
Probably helps with profitability, more in line with the future, and therefore an IPO more in line with the future. We have seen a lot of reporting about potentially Anthropic looking to tap the public markets.
Yeah, and I think a lot of the anxiety this week for OpenAI was Google's ascendant, but I think Anthropic is coming at it from the other angle here, where if they get to the markets first, if they prove that you can build a credible, competitive AI development business without incurring the same amount of debt and bleeding as much money in the next decade, investors might really gravitate towards that and rethink OpenAI's value here. So they're kind of being hit on both sides right now, OpenAI.
I think with Anthropic, it's worth reminding the audience about who they are beholden to or not beholden to, as the case may be. When I was in Vegas, I asked AWS CEO Matt Garman why he hadn't mentioned Anthropic in his big keynote, given that there's such a big investment for Amazon, for example, and Anthropic gets so much business through Bedrock and AWS. Could you just explain who their investors are and who they do rely on currently?
Yeah, I mean, I think the core backers for Anthropic are, certainly Amazon and Google, though recently Nvidia and Microsoft have committed to join the fray. So on the one hand, it was a pretty distinct investor base from OpenAI, but recently they're kind of overlapping more. Obviously, Microsoft's a key backer of OpenAI, Nvidia seems to be in both, and Google and Amazon have struck some deals with OpenAI infrastructure. So the caveat for everything Dario says is they're sharing investors, they're sharing partners, they're also spending a lot of money here, but they're trying to position themselves as a more measured and cautious compared to OpenAI in this regard.
Bloomberg's Seth Figgerman, thank you very much.
Time now for Talking Tech. First up, shares in Netflix under pressure today. According to CNBC report, the streaming giant is actually the front runner for Warner Brothers Discovery in the bidding. With a cash offer that covers some 85% of the deal, we understand bidding is expected to wrap up early next week. Plus, Morgan Stanley said to be considering offloading some of its data center exposure via a significant risk transfer. According to sources, the bank has held preliminary talks with its potential other investors about the transfer and is also exploring other ways to hedge part of its data center risk. And the EU, well, it's investigating the rollout of new AI-related policies by Meta's messaging service, WhatsApp. Regulators are reportedly weighing interim measures, including a temporary ban, alleging that WhatsApp's AI tools may soon unfairly block rival AI providers from offering their services through the platform, Ed.
Okay, let's get back to our top story, with Meta considering potential budget cuts as high as 30% for the Metaverse group next year, 2026. Minda Smiley joins us for more on this. She's a senior analyst at eMarketer focused on social media. What's interesting about this is the consumer's general attitude to technology, right? Am I going to use an AI tool every day, or am I going to jump headfirst into the metaverse? It's a big share move, but I think what I find interesting about your response is that you don't find it that surprising that there is being a cut back in the metaverse initiative.
No, I really don't find it surprising. If anything, I think people will wonder why these cuts haven't happened sooner. Because I think, even though AI and social media still remain incredibly popular, the reality is that a lot of people are actually trying to spend less time on screens, less time with technology. Even our own forecast showed that next year, at least in the US, we do expect people users on social media to spend less time on these social networks. And so, again, that's not to say they still don't spend incredible amounts of time on social, on with AI platforms, with technology in general, but there is a bigger push to pull back. And so I think even a few years ago, it really wasn't the time for the metaverse, clearly. And I think now it definitely is not.
To recap, this reporting is according to sources, and it's 30% budget cuts for Metaverse, but that will include an element of layoffs. I'm trying to understand the difference, right? Caroline and I have both spent a lot of time using mixed and virtual reality headsets, and I've spent a lot of time using Ray-Ban Meta smart glasses, right? Through one, you access the AI, the smart glasses, voice assistant-based AI with camera. The other, you immerse yourself in a virtual world. But why isn't there a sort of recognition of the overlap of those two domains?
Yeah, I mean, there certainly is some overlap, but I think, again, that there's sort of, even when you look at Meta's business overall, right, like we are seeing how AI is helping the business incredibly so. It's helping their bottom line. It's helping their algorithms become more powerful and keep people on the platform longer. But these loftier goals, these loftier ideas around superintelligence and even the metaverse we're just still not there yet. And I think the demand isn't even quite there yet to be justifying these massive amounts of spending. I mean, if we even see this with smart glasses, I will say I do think the smart glasses are having a bit of momentum. They've had some stumbles recently, but there certainly is some momentum there, but it's far from, a big portion of Meta's business and likely won't be so for for quite some time. And so, yeah, like you said, there is some overlap, but I still think there's the reality of what consumers are comfortable with now versus what they're going to be comfortable with 10, 20 years from now, which is it's just really hard to predict.
Okay, Minda, let's go to, therefore, the vast amounts of money being spent on the AI focus. And that's what's got investors riled, worried about the amount of debt that's going to have to be deployed, the potential move to negative cash flow, for example. Is that wise? When you're thinking about the intertwining of AI with social media, for Meta, it really paid off because it was more effective and advertisers loved it. But what about actually our use cases and how super intelligence is going to win for their business model?
Well, yeah, that's exactly right. I mean, we are, like I said, we are seeing how AI clearly is helping their business, but I think they are stumbling a lot more with their consumer-facing ventures in this space. I mean, even recently, when you look at Meta AI, their standalone app, Meta AI has been, worked into all of their major platforms. You can use it on Instagram, Facebook, WhatsApp, but the standalone app, as of last month, only had about 3.5 million users globally. So that's, 3.5 million is a lot of people, but when you look at the billions and billions of people that use their other platforms, it's actually quite small. So again, the demand for just like a pure play AI platform from Meta is still relatively small, especially when they are competing with ChatGPT and some of these other players. And so, yeah, there's sort of the business lane and the consumer lane, and I think the consumer lane, they're really having some struggles there.
But people are really using AI within WhatsApp, within Instagram. And then there's the issue of competition and whether they're stifling it. Over in the EU, they're worried about perhaps some policy changes to what they're offering of which companies can basically integrate in the API. And it looks as though both Copilot and Microsoft and indeed OpenAI could be pulling back from WhatsApp.
Yeah, for sure. I mean, I have to say I wasn't surprised to see the EU crack down on that. We've seen them kind of come down on Meta quite a bit recently. But it kind of goes back to my earlier point of when I was saying that Meta AI doesn't have that many users quite yet. That's why they're really kind of relying on putting it in their more mainstream platforms, trying to get people to use it on WhatsApp, especially, and Instagram and Facebook. And so, I wasn't surprised to see that they're making that push, but I'm also not surprised to see that pushback, that legal pushback that's happening, especially in an environment where Meta has really just been under the regulatory microscope lately. Here in the U.S., of course, that it recently won its antitrust trial, but when we look into next year, I think Meta, but also just social platforms in general, they're facing so much regulatory pressure at the moment.
Well, on the day we put to the one side and we see its best share move since July. Minda Smiley of eMarketer, it's great having some time with you. Now that does it for this edition of Bloomberg Tech. But Ed, what a day, what a scoop, what a market-moving story coming from Kurt Wagner.
Yeah, Kurt's story raises a question for me. In the future, what is the method for using AI? Is it smart glasses? Is it smartphone? Is it something else? We're back to that debate. Recap the reporting on the podcast. You know where to find it, on the Bloomberg terminal and online on all those platforms listed. From New York and from San Francisco, this is Bloomberg Tech.